What's happening, folks? It's Robbie here. So this is potentially going to be a once in a generation opportunity to build wealth, because now could be one of the easiest times to increase your net worth dramatically if you know what you're doing. After all, there's a popular saying that riches are made in recessions, and it doesn't take much to realise that we're moving towards that point. Just take a look at the headlines. Today, more than 9 out of 10 CEOs are bracing for a recession. 97% of CFOs are cutting costs by 10%, and JP Morgan warns the stock market could drop by another 20% from its current level. Now, even though this sounds negative, the fact is, recessions happen on a regular basis. And if used correctly, it's possible to set yourself up for the rest of your life through incredible opportunities and discounts. And even Warren Buffett is quoted as saying, "Bad news is an investor's best friend." So let's talk about exactly what's expected to happen between the next 12 to 24 months. The best benefits that you'd be able to take advantage of today, and precisely what you can do to make sure you're in the best position to make as much money as possible. All I ask is that you subscribe to the channel and like the video. Let's get into it. Alright, so before we talk about the best upcoming opportunities, you first need to understand what you're coming up against. And to start, we need to talk about a recession. Generally, recessions are accompanied by a significant rise in unemployment, a drop in wages, a loss in consumer confidence, and a decline in values across everything from stocks, energy, services and food, with sometimes long-lasting effects throughout the entire world. But second, along with the recession, usually comes a decline in earnings. See, every quarter, companies report their revenue and give guidance on their future outlook. But lately they've been cutting forecasts, bracing for slower and even negative growth, and citing recession risk at its highest in 10 years. That leads us to number 3, layoffs. When consumers earn less, they spend less. And when companies see less demand, they begin to scale back on expenses, with employees usually being the first to be let go. In fact, just a quick Google search of mass layoffs shows you dozens upon dozens of companies who are all trimming their workforce. And as Bank of America explains, the US economy will soon start to lose 175,000 jobs per month. So in terms of what that means for you and your investments, as well as how you can use this information to make money, let's start here with number 1, stocks. As of now, all 3 major indexes are down between 20 and 30%, with analysts like JP Morgan who believe we still have another 20% to go from current levels. However, if we take a look throughout history, since 1946, the average bear market drop was close to 30%, with the most severe having been in 2009, when the S&P 500 fell 57% from its peak. Now, once you combine the average with the recessions, bear markets tend to do even worse with an average drop of 34.8%. Which, just for reference, right now we're down about 25%. All of that is to say, generally the absolute bottom occurs when we see capitulation across all investors. Usually that's the time at the start of the recovery and things start to bounce back. Now I'll talk about how much you can make from all this in the next 2 minutes, but first we have to talk about number 2. Even though every area is different and some areas might continue to flourish, housing declines on a national level are actually rare. In fact, as you can see, throughout the last 60 years, there's only been a few times where meaningfully prices have dropped by 10%. But now the general Wall Street consensus is house prices are going to decline by 7%, with the worst case decline being between 10 and 15% should interest rates continue to increase. Of course, every market is going to be different, and according to Moody's Analytics, the most vulnerable markets could see upwards of a 25% decline, including parts of Florida, Arizona, Idaho and Southern California, with a decline lasting another 12 to 18 months before bottoming out. Now, on the big picture, it probably won't make a difference to people who have a fixed rate mortgage and intend to stay in their home for the next 5 to 10 years. But for anybody looking to invest or buy a house, we may begin to see some deals coming onto the market, which we'll cover shortly. Because we also have to talk about number 3, cash. Really, up until now, there's been this mindset that cash is wasting away to inflation. But whenever other assets are falling in price, sometimes cash can be the safest place to store your wealth. And you know that's significant when someone like the billionaire Ray Dalio admits that cash is no longer trash. The truth is that many people forget that as recently as 2018, cash was the best performing asset. And had you been saving your money in a high yield savings account, you would have far outpaced the market. Cash is now becoming such a significant part of portfolios that even fund managers are holding on to the most amount of cash since 2001. And Citigroup have said that cash is the only asset that investors can use to hedge against a recession. But as far as what you can do about this to make money, and why so many people never take advantage of what's about to come, here's what you need to know. Alright, In terms of why this next recession could be a once-in-a-generation opportunity, just consider this first. Everything becomes less expensive. The way I see it, even though one person might think this is a bad time to invest, with everything falling 30%, a wealthy person would consider this an opportunity to buy these companies at a 30% discount. Warren Buffett really had the perfect analogy for this when he said, "When hamburgers go down in price, we sing. When hamburgers go up, we weep." For most people, it's the same with everything in life, except for stocks. When stocks go down in price and you can get more for your money, people don't like them anymore. So firstly, reframe your belief, because a falling market could work to your advantage. Now second, there's less competition. The fact is, when times are difficult, companies scale back, they fold, they conserve cash and they play it safe. But this opens the door for smaller, more aggressive companies to stand up and take their place. For example, one study across 16,000 companies found that those who continued to advertise increased their value and got more bang for their buck, with positive growth for years after the recession ended. Third, there's way more opportunity. In a way, a recession is the market's way of weeding out the weak. And Patrick Bet-David made a fantastic comparison a few months ago, that the peak of the market cycle is exactly like a forest. This means that the largest, most established trees, or companies, get access to all the resources, or sunlight in this case. Everything at the bottom has a hard time being able to compete, and it's hard to grow. But just like natural forest fires, our economy has a way of repeatedly clearing out and bankrupting the companies that can't sustain themselves, giving opportunities for new, smaller businesses to develop and grow. And fourth, after every bear market comes a bull market. As Yahoo Finance points out, historically the S&P 500 has fallen 29% around a recession, with the median drop of 24%. But once stocks have found their low, the average return over the following year is 40%, and within 2 years the market has increased on average 58%. This means that investing on the way down is way more profitable than pulling out of the market and waiting. And long term, the market has always recovered, in every single example so far throughout history. And finally, fifth, you have to act before anyone else knows about it. I know it sounds so easy to think,
"Oh, perfect, I'll just invest during a recession."
but the truth is, recessions are never confirmed until months after the fact. For example, the Great Recession, which began in December of 2007, was not officially announced until December 2008, only a few months before it officially ended. The recession before that began in March 2001, but they didn't call it a recession until that November. And this continues with about a 6 to 12 months delay before we know if we're officially in a recession or not. But in terms of what you can do about this to profit, number one, scale back on your expenses. This means that you track the market, cut back on unnecessary spending, and operate lean while you continue reinvesting as much money as possible back into the market. This should also include a plan on what you would do if your income was to fall between 20 and 50%, how you could make up the difference, and if you could take preventative measures ahead of time to protect yourself from that happening. 2. Hold on to some cash. Now, I'm a big believer that even though statistically your money is best off invested as soon as possible, there is something to be said about having cash on the sidelines just in case you need something to fall back on. For me, cash makes up anywhere between 15 and 20% of my portfolio, depending on the time of year. But generally, this has given me so many opportunities to jump on good deals when they come up. And it lets me sleep at night knowing that whatever happens, I'll always have something to fall back on. 3. Protect your career. This, at the end of the day, would be the best hedge against whatever happens. Because financially, your worst case scenario is not the market going down. Your worst case scenario is losing your income while the market is going down. And then you have to sell off your investments at the bottom before they have time to recover. So now's the best time to improve yourself, learn new skills, and double down on whatever it is that you're doing. 4. Invest long term. The best course of action when it comes to investing is to carry on as usual as if nothing's happening. It's shown that dollar cost averaging, or the practice of buying into the markets on a regular basis, is the most profitable strategy. So stay in the market and continue buying. Remember, this isn't financial advice, just my opinion. And 5, diversify your investments. Now, if you personally can't handle a 20% drop without panicking, it's probably a sign that you're invested too aggressively. For instance, if you're completely in US tech stocks, then it's probably a good idea to add large caps in international stocks too, or potentially look into buying property or real estate investment trusts, where rents tend to be a little bit more stable. The more legs a portfolio has to stand on, the less likely it's going to collapse if one or two of those legs disappears. For me, I see a lot of value in continuing to invest as usual, holding a bit of a cash position on the side, and potentially starting a new business and buying real estate once the market has flattened. This is also a great time to double down on your work. Take on a side hustle and learn as much as you can, because whatever you do today will be rewarded many times over once the recession is over and the market begins to recover. It's definitely not going to be easy, but rest assured, it will be rewarding for those who stick it out and subscribe to the channel and like this video. With that being said, thank you as always for watching, and I'll see you next week. Take it easy.